Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Well, good day, everyone. Ira Epstein, and here we are. And this is Thursday, the 18th of August, 2011. The time getting out about 2:50 in the afternoon, Central Time. I want to remind you before I get too far ahead of myself, I'll have Barry Rosen on today from Fortune Cash to get an idea about market timing. And I know he and I have both been, in terms of timing, still bearish in the stock market, and that's the interesting part. I want to get something off my chest about the stock market as well. You know, in the commodity markets, you get the crude oil going up, the silver going up. We start hearing from the CFTC and the regulators, oh, there's just speculators trading in the market driving it. I want to say the same thing about stock indices. This is a market that's out of control with high-frequency traders. We keep hearing about it. We hear a lot about it. Tell me the good it's doing. I'm trying to understand what it's doing. It scares the heck out of everybody. They rarely take positions. Market makers, they're having a heck of a job trying to do anything. And when America took away its uptick rule 4 years ago, and if you understood that rule, it's like a circuit breaker. You need an uptick in order to go short again. Well, instead of doing what Europe did, that there's no short selling if you don't own the stock, I think if they put in that uptick rule, you would find this game would slow down again and become more manageable for the average person watching their portfolio, just being driven by computers. And you don't have to agree with me, and that's terrific. That's my opinion of what's going on there, and I don't see the good it's doing, but I'm always amazed when they'll say gold's got too high, this has got too high, it's too volatile. Volatile? Come on. That's volatile. Crude oil down $6 today because the world's ending. Now, what really happened is the European banks, well, we've known they're in trouble, and it's just a question of till when that all comes home to roost. Then we saw the Philadelphia numbers today from their Fed. Terrible numbers. We saw jobless numbers. They're climbing again. So what we have is a Congress on vacation, a president on vacation, nobody can get along and do anything, and people want to buy the stock market. The value play, and I'm the first one to tell you this because we're going to talk about metals, has been in the stock market. On the huge breaks, if you can buy the PEs that with a high dividend paying stock, it's way better in my opinion than 2% on a 10-year note if the world holds together. And if the world doesn't hold together, I really don't care about that note anyways. In the other markets, we're looking at rebar gasoline go down, and if you follow my webinars that I've been talking about, folks, I've been telling you, all we're getting is a rally towards those 18-day averages, and I thought it was going to fail. This is the market that I feel absolutely terrible that I didn't catch, the gold market on the second leg. I missed it. So for those of you that watch me regularly, understand, I missed it. End of discussion. Not that I'm not bullish, not that I haven't been writing about it, but so few people ever say, I missed it. I missed it, and that's in terms of the recommendations that I make to my clients to get back in after they got out in a really good shape. I didn't miss calling the silver on this leg for you. What do I mean by that? Let's blow up, and this is the SEP silver, and I'm going to be moving to DEES very shortly now. When the market got over this 39.86, I had mentioned, I did it in my webinars and so on, that until you take out 38.21.5, I think silver is ready to move back to the upside. Well, you're not running like you are in gold. Let's understand that. Gold is still the powerhouse, but you're not falling, and this is with the copper market lower today. How far can the market go? Well, that's going to be the question. I see the support back at the red line, the 18-day moving average of closes. And one of the theories that I teach in my course, and by the way, I'm recording all new chapters in my course, been doing it now for about a week and a half. I should be about half done next week, and the rest of it really flies. So I'll have my new trading course fully updated, ready to go for everybody. And remember, if you ever bought one in the past, I offer the new course to you without a charge for the course, just the cost CD, basically our time of making it and shipping it out. Looking at the market, take a look. You're breaking out to the upside. You've got all your moving averages under you, and the Bollinger Band is where I think the market's going to have its resistance. And that's around 41.53, and I think that number's looking better and better. Not that you have to go to it, but I like this sideways action out of the Bollinger Band. I'm not seeing silver is participating in just an industry like copper, where if the world markets and the slowdown happens, silver necessarily has to fall with it. It's got precious metal attributes to it as well. The problem for silver is it's not running as the precious metal gold is. Let's understand that. You're not even overbought. You're still in good shape here. So overall, I still like very much the picture there. In the gold market, it can rally till it's blue in the face. What I think it's going to do now is the stochastic study is not going to give you an opportunity. In other words, it's going to re-embed from the looks of it. And if it re-embeds, it means we're going to have to look at a pattern up in here and try to figure out a reasonable, quote unquote, whatever that means, because everything's got risk. Everything has risk, manner to try to approach the market. My guess is that I will be telling customers to slow the game down in my twice daily updates by using maybe some vertical call spreads. That's what I'm thinking. And I'll be looking at the pullback. I'm not certain you're getting back under 1725 in the near future. It depends what the stock market does, and you already know it's under the gun. Here's the copper market, and notice how it has stayed under the 18-day average. And one of the things is, while you got up yesterday over a previous high, you still are under the 18-day average. That is bearish as far as I'm concerned. Here's the crude oil market, and I'm going to take back today's action. All right? Here's the market coming up. One thing I know that I said, go look at the videos, you don't stay under a Bollinger Band that long, 2.5% of the time, and as each day goes by, the odds are you're going to trade back over it. That doesn't mean you have to run to the 18-day average, but that's what I teach. I teach that you should make a run up towards the 18-day average. Obviously, the game ends if you take out a swing line low of 85.86, because then the game starts with lower lows again. That's what happened today. So now until you take out 89.19, you're back, as far as I'm concerned, in the bear camp, and it would not surprise me if the market makes a run for that Bollinger Band. The gold-silver ratio, I've been a broken record here. I've been telling you I think it's just going to hang for a while. That's exactly what it's doing. Remember, this is a ratio of how many ounces of silver you need to buy an ounce of gold. When the ratio breaks down, silver's gaining on gold. They've just been hanging here in the 44 level. 40 was too cheap. 44 looks like it's the higher end of it, and we'll see what the market wants to do from there. Then you get to the note market, and this is the 10-year note. Now, this is a new high for the move. You're also under 2% return on 10-year notes. And this was the market that we were told people wouldn't buy U.S. Treasuries when we saw the AAA rating removed. We were told that eventually this market, as QE2 ends, we're going to have to pay higher interest rates, blah, blah, blah. Well, the simple fact is, if anyone thinks there's something wrong with America, why is this occurring? We're the best of a whole bad group of things going on out there. That's the right way to say it. I'm not saying we're in great shape. Not at all. But I also want to point something out. We're not, as a country, where we were in 2008 in terms of our financial institutions. We're in a terrible position in terms of jobs, and until jobs get created, you can take all the rest you want to do and inflate balance sheets, you don't get things going. You need to get them going. And you need to get them going and keep them going because corporate earnings drive stock markets, returns on money. Homes get bought when people have that money. And if interest rates keep falling, if banks will lend, homes will get sold as well. It all ties together. Well, I try to tie other things together for you as well in our futures trading kit. And this is part of it. It's called an introduction to options. We have many of these type of things in this kit. And it's simple. It's several sheets, and it explains the idea of options, puts, calls, the different strategies that come out from there. We do talk a lot of options trading from time to time in our different updates. Some of my brokers actually put out their own reports on options. Some of them just do nothing but options. So if you're looking for a way to maybe slow the game down a little bit, if you just buy a put or a call, you have a defined risk. Don't have to worry about the craziness of the market. What is a strike price? Where does the market go in your favor or not go in your favor? Well, it's all here in this book. And as usual, be it an option or futures, there's risk associated with it at all times. So give us a call, 1-866-973-2077. And I want to sum it up by here is picture perfect of what I teach. Market came down, stayed under the Bollinger Band. You're going to bounce. I'd look for the 18-day average of closes to be approximately or at that number, right in that zone where the market runs into problems. The market yesterday, this is where it got. Take a look at it. It's very, very clear. This is today's action. And all that I'm saying is that that's a resistance point, and when the market's up and over it, it's a support point, and yes, it can slice through it, but most times what I look for, it doesn't mean it happens, is for that to act as one of the breaks in the marketplace. And if you go to the Brent, you got it clear as can be. Look at this Brent. Here's Brent coming up. If you get over this number right here, you're going to end the downtrend, and I say run into a brick wall at the 18-day average of closes, get back under 108, and you actually start another downtrend. Bingo. And that's how I see this market working right now. Hope that helps some of you out there. I'm Ira Epstein. I'm having Barry Rosen. I'll be staying here in this outfit in just a few minutes. Have yourself a good day.